Hi everybody, Eric Wilson with iCell Health Incorporated. Hope you're having a fantastic day. Following up with you with our discussion from last week on key considerations when buying life insurance. Today's question is, the second and third question was, what kind of policy should I buy? Should I buy term or permanent? And then I guess with that is that the following question to follow up is, what are various types of permanent insurance? So we'll talk about the first question first, the permanent or term. Every situation is a little bit different, so it's tough to answer the question with a blanket statement. However, I kind of believe you need a little bit of both. You should definitely have enough enough term insurance, to cover your dime. If you recall, we said dime was death benefit, the D, the I was income, M was mortgage, and E was children's education. So you need enough term insurance without question to cover your dime. All right. Then after that, you start looking at maybe some permanent insurance, and with a lot of plans, you can actually convert some of your term policy into permanent insurance down the road. So sometimes it's something you'll have to think about this very day, as your needs as your needs change, you can convert some of this. But from a permanent side of things, you need some because your term eventually runs out. So if you have a 20-year term and you're 30 years old, your term policy is going to run out when you're 50. Right? Then you can either get another term if you need another term, or you're going to need to get a less amount. Or you can start now today, because life insurance is probably cheaper today than it will be 20 years from now. And even if it's a small amount, whether it be a whole life or a universal life, or maybe even a 20 or 30, $50,000 death benefit, that way it's permanent. That you always have. One of the nice advantages of permanent insurance is also they build cash value. But both whole life and universal life build a cash value, which under IRS code 7702 you can withdraw tax-free. So oftentimes you can use them as retirement plans as well. And how many retirement plans out there come with a death benefit? Other than life insurance, none. So a nice way to fund it, especially if you fund it correctly. You can have a nice retirement income buildup, but that's probably really another day's discussion. So when it comes to term insurance, again, the term is the length of the term, 10, 20, 15, 25, 30, whatever you need. You want enough to cover your dime. However that must be, and we told you how to calculate that a little bit, all right? And that's a general view. The younger you are, probably the more term you need. Term is also good because it costs less, because there are, it's kind of like your auto insurance to an extent, where if you don't crash your car or don't have a homeowner's claim, you've just paid the insurance. And that's what term insurance is. It's actually pure insurance. There's no cash value, no nothing. It's if the term runs out and you haven't used it yet, then you haven't used it yet. And I guess that's good that you're still alive. It's also good for the insurance company because they didn't have to pay it out. So that's how we're doing it. On the permanent side, again, we go up whole life, which most of you heard of. On the universal life side, there is, what's called variable universal life, which is which is basically in the stock market. It goes up and down. It can and does lose money sometimes. It can also grow. There's index, which is not in the market, but it's tied to the index, whether it be the S&P 500 or the NASDAQ, or whichever one you choose. And those are great because you never lose money in them. You always have your initial principal, and your gains are reset every year. So that's a nice little advantage there. Again, that's a later discussion when we get further into the permanent life topics. But that's what I got today. Eric Wilson, 888-448-5370, www.icellhealth.com. Have a great day.